In your investment portfolio, there may be some stocks and ETFs and mutual funds which are in the green. That means you're making money. That's a good news. And there may be some stocks and ETFs and mutual funds which are probably losing money and they're showing red in your portfolio. So overall, there may be a situation where you have more losses than your profit, realized and unrealized. So you must be wondering if there's a way to recover some of these losses. And the good news is, yes, there is a way. If you watch this video till the end, I'm going to show you some tips and tricks and few things to avoid in order to get some extra cash in your pocket. Hello, welcome back. My name is David Das of thinkandretire.com. Please remember that I'm not a financial advisor or a tax consultant, and this video is not meant to be an investment advice of any kind. So let's get started, and I'm going to use a presentation slide to discuss this topic. If you're watching this video for the first time, please consider subscribing to this channel so you do not miss my future videos. If you like the content of this video, please press the like button to support my channel. And I really thank you for doing that. Let's get started with the presentation. First, I will cover the definitions of capital gains and capital loss, followed by an example explaining how it works. Then I will talk about certain rules that we need to follow. And lastly, I will talk about the different step-by-step process that we can undertake to use this strategy. So what is a capital gain? If the purchase price of a stock or an asset or an ETF or a mutual fund is $100, which is later sold for $200, the capital gain is $100. That is the difference between the sale price and the purchase price. According to Canada Revenue Agency, the taxable income is only 50% of the capital gain. That is, in this example, the taxable income will be $50. The capital loss is the reverse of capital gain. If the purchase price of a stock or an ETF or a mutual fund is $200, which is later sold for $100, the capital loss is $100. That's the difference between the sale price and the purchase price. In Canada, CRA allows us to offset the capital gains with capital losses for that year, in any 3 preceding years, or in any future year, because the capital losses never expires. This strategy is available only in non-registered accounts, so we cannot apply this strategy in RRSP, RESP, or TFSA accounts in Canada. This strategy is called tax loss selling, also known as tax loss harvesting. So let me give you an example. Let's say this is the year 2022. I bought 1,000 shares of stock AAA at the purchase price of $50, and then I later sold them at $40. So I have a loss of $10 per share times 1,000 shares, so the net loss is $10,000. I also bought 500 shares of BBB at $100 per share, which I later sold for $110 per share. So I had a gain of $10 per share times 500 shares, so there was a net profit of $5,000. So in this example, the net loss is $5,000. There are a couple of important things here in terms of the date. The selling has to be settled within the same calendar year. So that means for the year 2022, the last trading date has to be on December 28th, because the settlement date is on December 30th, which is about 2 days from the trading day, and December 31st falls on Saturday. So it doesn't matter whether we bought the stock in 2022 or in previous years. The selling settlement has to be completed within the same calendar year if you want to claim the capital losses for that year or 3 preceding years or in future years. If no capital gains is available in 3 previous years, we carry this loss forward into the future years. There are certain rules for this strategy. The number one is the trade deadline, which I just explained. For 2022, the last trading date has to be on December 28th because the settlement date will fall on December 30th, the last day the market is open, as December 31st falls on Saturday. There is a rule called superficial loss. That means we cannot apply this strategy if we buy the same stock or identical securities within 30 days of the settlement date. It also applies for affiliates. According to CRA, the affiliates are yourself, your spouse, or common law partner, you and a corporation controlled by you, your spouse, or common law partner, a partnership and a majority interest partner of the partnership, a trust and its majority interest beneficiary. The identical securities can be shares of the same company, units of the same ETF, or mutual fund that invest in the exact index just sold. Now I'm going to explain the step-by-step process to apply this strategy. Step number one, log on to your CRA account and go over to the carryover amounts. You will see something like this. And look at line 127, which is the taxable capital gains for different years. But we are only interested in the first 3 years and write these numbers down. The step 2 is to keep track of all your transactions history for the year and calculate if you have a net capital gain or a capital loss, as shown in the example I just presented before. Step number 3. To carry a current year net capital loss back to 3 years, complete the CRA's Form T1A, which is called the Request for Loss Carryback, and submit to CRA. Note the Part 5 of this form. Depending on your situation, you may get some refunds back from CRA. The most important thing, as you have probably realized, that we have to be very mindful of different deadlines to apply this strategy. So there you have it. I hope you have enjoyed the video, and I'll see you next time. Thank you.